It looks like free money. It isn't, but it's close enough that it should make you uncomfortable. Right now, some of the biggest institutions on earth borrow trillions of dollars, at rates so low they barely register, sometimes overnight, sometimes for days, sometimes for weeks, and they do it without begging, without pitch decks, without risk, at least on the surface. Meanwhile, most people would be thrilled to get a loan under 10%. So what's the trick? And why does it matter more now than almost any other moment in recent history? Let's start with a scene that plays out every single day, mostly in silence. It's 8 a.m. in New York. Markets are waking up. Banks, hedge funds, and giant asset managers are already talking to each other, not about stocks, but about cash. Who has it? Who needs it? And who can lend it safely before the day ends? Because cash is oxygen. If you're a massive institution and you run out, even for a few hours, you're dead. But here's the strange part. These institutions don't borrow by promising future profits. They don't borrow by convincing anyone they're trustworthy. They borrow by handing over something everyone already agrees is almost as good as cash itself. Debt, specifically, government debt. This is where the story gets weird. Imagine you own a US Treasury bond. It's boring. It pays a small interest rate, but everyone believes the US government will pay it back. That belief is everything. Now imagine you walk into a deal and say, I'll give you this bond today. You give me cash today. Tomorrow, I'll give you back your cash, plus a tiny bit extra, and you give me back the bond. That's it. That's the trick. It's called a repurchase agreement, a repo, but don't get distracted by the name. Think of it as a pawn shop for the financial elite. You pawn ultra-safe debt, you walk away with cash, you come back tomorrow, and reverse the deal. Because the collateral is considered nearly perfect, the interest rate is tiny, often fractions of a percent, sometimes effectively zero. That's how institutions borrow almost for free. And this market is enormous. At any given moment, trillions of dollars are moving through repos, not yearly, daily. This isn't some niche corner of finance. This is the plumbing. Now here's where it starts to matter. The system only works if everyone agrees on one thing. The collateral is safe. Not profitable, not exciting, safe. Government bonds sit at the top of that hierarchy, especially US Treasuries. They're treated like financial bedrock. They're used to price risk, settle trades, and stabilize balance sheets, which means the demand for them isn't about belief in government brilliance. It's about survival. Big institutions need these bonds not to invest, but to borrow. This creates a quiet feedback loop. The more the system relies on borrowing short-term cash, the more valuable, safe, debt becomes. The more valuable safe debt becomes, the cheaper it is to borrow against it. The cheaper it is to borrow, the more leverage builds up. Leverage is the unspoken word here, because when borrowing is almost free, restraint disappears. Why not borrow more if it costs nothing? Why not stack positions if funding is cheap and constant? This is where the math turns uncomfortable. If you can borrow at, say, 0.2% overnight, and you can invest that money into something yielding 3%, the spread looks harmless, conservative, even, until it isn't, because this entire system assumes tomorrow looks like today, and sometimes, it doesn't. In September 2019, something odd happened. Repo rates suddenly spiked. Overnight borrowing costs jumped from near zero to almost 10%. Nothing dramatic happened in the news. No war, no crash, just a quiet shortage of cash. The system seized up. The Federal Reserve had to step in and flood the market with liquidity to calm things down. That was before the pandemic. In March 2020, it happened again, but louder. Markets panicked. Even treasuries were being dumped, not because they were risky, but because everyone needed cash at the same time. The safest asset in the world briefly stopped functioning as expected. That should tell you something. The trick that makes borrowing cheap also makes the system fragile, because when everyone depends on the same collateral, stress spreads fast. There's also an irony here. Governments issue debt to fund spending. Institutions buy that debt not to hold it, but to use it as a key that unlocks endless short-term borrowing. So public debt becomes private infrastructure, and the more debt exists, the more fuel the system has. This flips the usual story. High government debt doesn't just affect taxpayers or future budgets. It underpins daily liquidity for global finance, which means disruptions in trust don't just hurt markets. They threaten the mechanism that keeps them running. That's why interest rate hikes hit harder than people expect. When central banks raise rates, repo costs rise. Borrowing isn't free anymore. Margins shrink. Leverage becomes dangerous. Things that looked stable at near zero rates suddenly don't work. This is why tightening cycles break things, not immediately, quietly, in places most people never see. The hype says borrowing cheap is a sign of confidence, that markets are healthy, that risk is low. The reality is more delicate. Borrowing is cheap because everyone agrees on a shared illusion of safety, and as long as that illusion holds, the machine runs smoothly. But it's not magic, it's trust, math, and timing. And trust doesn't crack slowly, it snaps. So here's the question to sit with. If the global financial system depends on borrowing against government debt at near zero cost, what happens when that debt stops feeling unquestionably safe? Not hypothetically, just enough doubt, just enough friction, just enough cost. Because when the trick stops working, it doesn't unwind politely.